Stocks trade firm but ranged ahead of the US CPI inflation print. Pharma as well as auto eke out gains while FMCG drags today.
Pharma stocks gain as Q4 is expected to see an improvement in margin owing to a decline in input and freight costs, even as key drugs keep exports healthy. Divi's and Biocon lead the pack higher today.
The price of raw sugar hits a 11-year high as unseasonal rains in India and lower supplies from other producing nations fuel the prices. Stocks of sugar mills rise on this cue.
Sula Vineyards heads higher on its strongest quarterly sales. Puravankara jumps on a strong Q4 update while a mega order win buoys BHEL and Titagarh Wagon.
Industry leaders Kumar Mangalam Birla, Sanjeev Bajaj, TV Narendran and Venu Srinivasan tell CNBC TV 18 that global uncertainties are a big concern, even as focus on infrastructure development and growth can keep India resilient. Hello and welcome. You've tuned into Business Lunch. I'm Nisha Poddar and with me as always is my co-anchor Pavitra Parekh. So Pavitra, green on the screen, but there are lots of macro data which can really spoil the party for the markets, and therefore it is tentativeness as well as a tight range that we had been seeing. But at the moment, Nifty 50 at 17,772 levels, comfortable with about 50 points of gain, 0.28% up. When we talk about Bank Nifty, well, there we see an underperformance compared to the key indices, but definitely on the positive side today. And the mid-cap universe that is outperforming the key indices closer to 0.5% gain at the moment. Remember, it's a truncated week as well, and lots of global cues to look at, including the US CPI inflation print. So advance decline ratio in favor of the advances because of the mid-cap universe participation. And on my screen, Divi's Labs, Bajaj Auto, Dr. Reddy's and some of the Adani Group stocks are the ones bigger gainers in terms of percentage for Nifty 50, Pavitra.
Oh, absolutely. And like you said, another green day. While it looks flat on the surface, not too much of a move. There's solid action beneath the surface, especially in the pharma pack, right? So take a look at something like Divi's surging in trade. We'll pull that stock up for you. And a lot of the other names as well. So whether it's DRL, you have Cipla, that entire pack doing well. Biocon also holding up really well right now. So the entire pharma space is in focus. Tech ahead of TCS's earnings, all at the high point of the day. Started pretty weak, but they've all moved to the high point. So watch for that. Sugar is seeing a big move up. So a lot of the smaller mid-cap sugar stocks doing very well. And on the downside, once again, it is really consumption which is seeing some cuts. So that's what's happening with the market. We'll come back to this. But first up, let's start off with that big cue that we're all tracking for our own markets. It is earnings season. It begins today with IT Bellwether TCS due to report Q4 earnings later in the day. So Rima is joining us to take us through everything that we should expect this time around. Rima.
Thanks so much for that. So we're looking at a dollar revenue growth of 1.9% on a quarter-on-quarter basis. In constant currency terms, it's expected to be a growth of 1%, but the range of estimates from the analysts is quite wide this time. There are a few analysts who are expecting a flat growth, and then you've got some expectations going up to a 1.7% growth. But what you need to bear in mind is that Q4 growth is likely to be less than Q3. Margins for TCS are likely to expand by 50 basis points to 25%, driven by the easing of supply-side pressure, improved utilization, and better efficiency. What will you watch for? The BFSI exposure of TCS stands at more than 30%. We've seen a global banking turmoil. Is it impacting BFSI revenues or deal conversions? Have banking clients paused on their tech spend? Are they being conservative? So the outlook on BFSI is going to be very crucial. Secondly, in an uncertain environment, the view on deal wins and deal pipeline in general. Now, TCS has guided that deal wins every quarter will be within a band of $7 to $9 billion. Will this continue even in FY24? This quarter, in Q4, deal wins are expected to be fairly robust. And then, thirdly, TCS has a new CEO designate who officially takes charge in September, K. Krithivasan. So priorities and strategic direction of TCS under him will be tracked. Back to you.
All right, thanks Rima for giving us a heads up on what to expect from TCS, and you can catch Rajesh Gopinathan, the outgoing MD and CEO of TCS, addressing the media at 5:30 p.m. their earnings release on CNBC TV 18. So don't miss that one. All right, so corporate India, that remains positive on India's growth story. In fact, Sanjeev Bajaj as well as TV Narendran tell CNBC TV 18 that global uncertainties are a big concern, but India is on course for stable growth. Let's listen in.
Very clearly, we are in a period of global uncertainty and a fairly extended period, and we still don't see the light at the end of the tunnel. I think in this situation, the significant, I would say, coordination between RBI and the Finance Ministry has put India on a very steady course of stable growth. And we can see that RBI is deftly managing both inflation, which is one of its foremost tasks, but keeping an eye on growth as well. And the rate pause that we saw this time is a welcome signal of that, while keeping in mind that, as RBI has very correctly said, that it will see how things are moving on the ground and decide what to do.
I think, globally, of course, there is some concern because of the fragility of some of the economies. But I think the Indian economy, because of the focus on infrastructure, is looking good. Steel consumption, in my view, should reflect the GDP growth rate. So if we say the GDP is going to grow at 6.5–7%, I expect steel consumption to grow at least that. Our growth will be dependent on the capacities that we build. We are in the middle of a 5 million ton expansion, which should be completed during this financial year. But obviously, we'll get the benefit of that in the next financial year.
All right, that is the word coming in from Sanjeev Bajaj as well as TV Narendran. But some more exclusive opinion for you. My colleague Shivani also caught up with Kumar Mangalam Birla, chairman of the Aditya Birla Group, and asked him about Voda Idea's 5G plans amidst lots more. So listen in to what he had to tell us.
5G rollout will begin soon.
Sir, any headwinds that you see impacting the Indian businesses and the industry, as in the oil prices we have seen as a concern? What are the other headwinds that you see as challenge to the Indian economy?
So I don't see oil prices as a headwind. I think that, commodity cyclicality has always been the case. And as Indian business, I think that we've learned to live with cyclicality, and Indian business is truly world class and of world quality in every way. I wouldn't say that that's a major, that isn't a bend in the road, if I can say that.
Sir, last question. The finance minister in USA has said that India will be pivotal in the value chain, global value chain. What do you have to think about it?
I think so. I think the China plus one theory is playing out in India's favor, very much so. That's a fact. A lot of people who are now wanting to be in India, invest in India, and in the India growth story.
All right, some of the big wigs from corporate India talking there in New Delhi. With that, we'll slip into a short breather on Business Lunch, but CPI inflation numbers for the month of March will be released later today, and we get you a preview into the numbers on the other side. Don't go anywhere.
Welcome back. You're still tuned into Business Lunch. Now, the International Monetary Fund has trimmed its global growth forecast and has also cut the GDP outlook for India, so warning of high uncertainty and a larger risk of a hard landing, especially for developed economies. So while it cut India's growth forecast sharply in its latest World Economic Outlook report, this is down to 5.9% for this year, it sees global growth bottoming at 2.8% in 2023, before then seeing a modest recovery come through next year. So Ritu is here with all of the highlights from this report. Ritu?
The IMF has handed a sharp cut to India's growth forecast in its latest World Economic Outlook report, both for the current and the next fiscal. For FY24, IMF has forecast India's growth rate at 5.9%, which is 20 basis points lower compared to the January forecast and much lower than RBI's estimate of 6.5%. Thereafter, India's growth is seen picking up to 6.3% in FY25, but this too is about 50 basis points lower compared to the previous forecast. The fund estimates that India's inflation is going to average 4.9% in this fiscal and 4.4% in the next, which is a tad more optimistic than RBI's projections. On the global front, IMF says prospects for growth now seem dimmer than in decades, and any tentative signs in early this year that the world economy could achieve a soft landing have receded amid stubbornly high inflation and the recent financial sector turmoil. IMF's baseline forecast, which assumes that the financial sector stresses are contained, is for global growth to fall from 3.4% last year to 2.8% this year before rising slowly and settling at 3% 5 years out, which is the lowest medium-term forecast in decades. In fact, the risk of global growth falling below 2% this year, a low growth outcome which has only happened 5 times since 1970, remains elevated at about 25% chances. Now, IMF warns uncertainty is high and a hard landing, especially for advanced economies, has become a much larger risk. Many economies are likely to experience slower growth in incomes this year, and the world economy is not currently expected to return over the medium term to the rate of growth which prevailed before the pandemic. A quick word on inflation as well, which is high but starting to decline. The baseline forecast is for global headline inflation to fall from 8.7% last year to 7% this year and 4.9% by 2024.
All right, thanks Ritu for summarizing that report. Not very encouraging words coming in from IMF, especially on India's growth and global economy. Let's in fact listen in to the IMF's India mission chief on the rationale behind cutting India's growth forecast.
This so-called revenge, consumption has happened much more strongly in the previous years, and the catch-up towards potential had already happened. And so we do not expect any catch-up or a little bit less catch-up for the next fiscal years. This explains our reductions. I think we still overall think that India's economy is performing well against the global economy. If these risks materialize jointly, we could see potentially quite a severe impact on the global economy, on emerging markets, and including on India.
All right, and India's March CPI will be announced today at 5:30 p.m. along with the February IIP numbers. And CPI is more important since it drives, remember, the RBI's interest rate policy. All eyes have been on that one. Lata Venkatesh is here with what the street expects from the numbers today. Lata.
Well, the big number to watch out for, the March CPI, is, according to our poll, expected to come in at 5.63%. A very good number compared to the previous month, February, which was a shocker of 6.44%. A word on why it is as low as 5.63 compared to last month. Because a year ago, if you remember, March was the month of the Ukraine war. So inflation had shot up from about 5% in February to 6.95 in March of 22, and even April it went on to 7.79. So the high base is going to help us. The high base of edible oils and cereals prices will make March of 2023 look benign. But coming back to the 2023 numbers, February was a shocker, I told you, largely because of food. There was some recalculation by the NSO, rearranging of weights, but importantly, milk was a shocker, and the expectation is that in the current month under review, March as well, milk may still inch up higher because we've heard a lot of dairy companies announcing higher prices for March and for April. Sugar could be a bit of a bother because we're seeing those prices inch up, as are pulses. I mean, they're likely to remain steady. But the positives are expected to come from cereals. Heat waves notwithstanding, the arrivals from the mandis are reportedly good. So we should see that one coming down. In core, which is largely services, you count something called personal services, and surprising as it may seem, gold is calculated under personal services. Now, gold prices went up for international reasons, and that may keep the core inflation as high as it was in the previous month. But if it is 5.63, the RBI will be vindicated. If it is anything closer to 6, the RBI's pause will be questioned.
All right, Lata, thanks a lot for that. So that is the big number to track for our own markets, the inflation data. By the way, speaking of inflation, investors will also be tracking the March consumer price inflation in the United States. That's a big one to track as well. And the Fed's minutes will also come out. So there's lots for us to really look at today.
Oh, that's right. So lots of economic data that is going to really impact our markets as well. But while we digest that, let's slip into a short breather on Business Lunch. We get you excerpts from an exclusive conversation we had with Anthony Capuano, who's the President and Chief Executive Officer of Marriott International. Stay tuned. Welcome back. You're watching Business Lunch, and markets in good stead. In fact, Nifty 50 gaining. But let's get you an interesting insight on the comparison between investment in the hotels versus investment in hospitals. Who would have thought about this comparison? Mangalam Malu is right here with all the details of that interesting report. Mangalam.
Well, it's an interesting note which is coming from Jefferies this morning, and it compares hotels and hospitals as investment options. Now, intuitively, these are as different as mini bars and medicine boxes, but they do have a lot of similarities if you just take a look at it from the business standpoint, because both industries belong to the service sector, have buildings and rooms for which they share similar key operating metrics like average revenue per occupied bed or average revenue per available room, and occupancy, capex per bed or room, EBITDA per bed or room. And for both these businesses, what differentiates them from their competitors are location, quality of experience, as well as building rooms or beds. Now on to the differences in these two. Of course, we know the differences between hotels and hospitals intuitively, but for hotels, it is a more discretionary spend. People willingly spend on hotels, and that's why it's partially depending on the overall buoyancy in the economy. Whereas, the other thing that they have going for themselves is that there is no dearth of quality manpower. Whereas hospitals are concerned, they are unaffected by short-term economic activities, and they are more driven by clinical excellence. And of course, the biggest challenge they face is that there is a limited surgeon pool. I guess it's easier to train someone to make a bed than to perform brain surgery. So let's talk about the revenue and EBITDA CAGR projections for both these industries. Between FY23 and FY25, hotels are expected to grow in about 10 to 23% revenue, 14 to 34% EBITDA. Hospitals between 10 to 14%, and the EBITDA grows at a measly 11 to 16%. However, in terms of return on capital employed, and that's where hospitals beat hotels, they have a higher range of almost 8 to 27% as against hotels, which are 10 to 11%. And the biggest reason for that is hotels have a daily rate of anywhere between 12 to 15,000, accounting for all the cyclicality, whereas at a multi-specialty hospital in a metro, the rates could go all the way up to 75,000 as well. So hotels grow faster in up cycles, but hospitals are a lot more consistent over a long period. And perhaps that's the reason that, when it comes to valuation multiples, hotels have a range of 12 to 20 times, which is a little less than hospitals, which are 14 to 21 times. So what should you invest in? Jefferies suggests that if you're looking for the short-term growth, hotels in an upcycle, that's the place to be. But if you're looking for consistent performance, superior ROC over the long term, hospitals, that's what you're supposed to do. And that's what stock returns are suggesting as well. If you just take a look at the short term, over the last 12 months, the hotel stocks, Indian Hotels, Lemon Tree, they've beaten, the returns of Apollo Hospitals and Fortis, both of them down 7 to 8% as against the others, which are gaining. But if you just take a look at the long term, the biggest hotel player and the biggest hospital player in the country, we've seen the hospital player outperform by about 300% in terms of gains over the last 5 years, whereas Indian Hotels is done 137%. So finally, just don't mix up your stocks with your pill bottle. So if you're looking for some top picks in this space as a portfolio, Jefferies recommends Indian Hotels with a target of 380, Medanta with a target of 630, and Max Health with a target of 530. So that's hotels and hospitals.
All right, Mangalam, thanks a lot for getting us all of the details there. We've all definitely been talking about it, right through the morning. Very interesting note coming through. A little bit of a strange comparison, but, interesting note.
But I would say that the biggest difference between the two, not in terms of investment, is that nobody willingly checks into a hospital.
Which is why it's a strange comparison, right?
Yes,
Exactly.
Yes.
But that is Jefferies on hotels versus hospitals. Mangalam, thanks a lot for that. But speaking of the hotel industry, Anthony Capuano, CEO and President of Marriott International, says that he does not see an end to the upcycle of the hotel industry's recovery in the near future. Speaking exclusively to Shireen, he also laid out the hotel chain's plans for the Indian market. Take a look.
The company set records for fees, adjusted EBITDA, adjusted EPS. And remember, we achieved those numbers with a very difficult January because of the Omicron variant, and with China, one of our largest markets, largely locked down for 10.5 months of the year. So our forecast for 2023 is for continued strong growth. As you point out, we gave a relatively large range of RevPAR growth globally, 6 to 11%. So 100 or 200 basis points wider range than we might typically, because of some of the economic uncertainty you described. but I was in Boston last week or 2 weeks ago meeting with analysts. All of them ask the right logical questions. Given the interest rate environment, given inflation, given socio-political instability in certain areas of the world, don't you see an end to this tremendous arc of recovery? And the answer is we don't see it in the data yet. The first quarter should be really, really strong when we report earnings in a few weeks. We continue to see strong forward bookings. The only caveat I would give you is for transient business, we're dealing with a relatively short booking window. So the ability to tell you forward bookings look good could change relatively quickly, but we're just not seeing it in the data yet.
Well, that's good to hear that at least at this point in time, demand visibility tells you that things are still holding. I want to talk about India because we are here and there's a lot of attention and focus on how compelling the India story is at this point in time. From Marriott's perspective, you had set a target of 200 hotels by 2025. I believe you're hoping to up that number?
Yeah, we hope, our expectation is that between open and pipeline hotels, we'll have at least 250 hotels across the country by 2025. We're in 40 cities today. That should be 50 cities or more by 2025. And maybe most exciting to me, that results in us creating 10,000 new jobs across India.
You talked about the pipeline in India. Which end of the market do you believe you feel that you're going to see much more sort of demand coming in? What is going to be the priority in terms of what you intend to focus on here in India?
Well, I think in any market in the world, our development strategy is relatively simple. Our objective is to make sure we have the right product in every market our travelers want to visit for any type of trip purpose. I think here we've got to continue to stay focused on the domestic market, which is strong and growing. And I mentioned to you earlier, we had the good fortune to spend a bit of time with your tourism minister. And one of the things we talked about is the importance as an industry, and certainly from Marriott's perspective, to continue to tell the story globally about what a rich and diverse set of experiences the country offers. And we want to make sure we have lodging offerings in all of those destinations.
All right, as we wrap up Business Lunch for today, here's some somber news coming in. Chairman Emeritus of Mahindra & Mahindra Group, Keshav Mahindra, passed away at the age of 99 this morning. And Mahindra was the chairman of the conglomerate between 1963 and 2012 and retired in August 2012 after heading the group, remember, for nearly 5 decades. Handing over this particular position now to his nephew, Anand Mahindra. And Mahindra is known for his philanthropy and also contributed to the cause of building ethical corporations in India.